Hamoon Soleimani argues in a December 2025 analysis that the long-standing 2% inflation target central banks have relied on for more than 3 decades can no longer be reached without causing major financial damage. According to the author, the modern economic structure has become so dependent on non-stop liquidity, suppressed interest rates, and constant refinancing that hitting the official target would break the very system built through years of aggressive monetary expansion. The idea of a 2% target began in 1989, when New Zealand attempted to recreate what felt like a stable period in the past, rather than relying on detailed economic science. Other central banks copied the model, turning an educated guess into global doctrine. Yet the world of 2025 is defined by extreme financialization, fragile supply networks, and a towering global debt load that requires continuous cheap funding simply to remain standing. The framework was created for a world that no longer exists. New money enters the system unevenly, flowing first into financial markets, corporate balance sheets, and real estate. Asset holders gain purchasing power while wage earners deal with higher living costs. Reaching 2% would require crushing household demand, but that same pressure would also wipe out inflated asset values that families, pension funds, and governments rely on. The moderate rate increases during 2022, and 2023 already produced bank failures and growing sovereign stress, revealing how little tightening the system can absorb. Inflation measurements make the confusion even worse. Owner's equivalent rent understates real housing costs, while healthcare, childcare, and education have surged, yet carry limited weight in official data. A family facing doubled rent and soaring medical bills is still told inflation sits near 3%, showing how far policy targets have drifted from daily experience. The United States debt burden adds another impossible constraint. By November 2025, national debt reached roughly $38.12 trillion. The fiscal year 2025 deficit was about $1.8 trillion, and the calendar year total grew by more than $1 trillion. Interest costs are nearing $1 trillion per year, leaving almost no room for genuine tightening without risking a sovereign crisis. Fiscal plans like the proposed $2,000 tariff dividend push in the opposite direction. Tariffs work like consumption taxes and raise prices across the economy, while sending out large payments at the same time would fuel another wave of demand. The Federal Reserve ended quantitative tightening in December 2025, after reducing its balance sheet from $9 trillion to $6.6 trillion. But the system has grown dependent on abundant reserves. Shrinking further risks severe liquidity stress.